one of the ways I was able to quickly learn footprint and adapt sort of market profile and auction theory and sort of transplant that to understanding footprint and to sort of speed up my learning process and applying and using footprint to trade. And I thought this week actually I could go through two things, two big market profile patterns which you can very easily adapt into footprint. But those two will be more of an example of how you can actually do this, like move your understanding from one area to another. So if I just dive in very quickly. Yeah, so we're doing it on adapting market profile intuition to learn footprint. And the reason you can actually do this in the first place is, of course, as I mentioned before, markets are fractal. The auction process is very fractal as well. You can apply it to any sort of time frame, even though time frame itself is a very crude sort of word for this. But because the auction nature is is the same within a 5-minute sequence or within a day, you can sort of transplant the same logic with a few tweaks here and there and understanding the relevant context between those two. And again, because you have a certain logic and you have a certain reference point to use, it's much easier to know what you're looking for while you're trading that structure, as it were, once you're trading within that footprint structure or market profile structure and so on. But this is something I emphasized last time, and I always emphasize. There's no point seeing the pattern and look, I see the pattern. Okay, I'm going to trade it. It's much easier. You'll be much more consistent, and you can understand the nuances much better if you understand why and how that how that day unfolded, why it unfolded. So why we have the certain positioning or shape of the profile, and again transplanting that same to the footprint as well. And of course, do not take it at face value and always have it within a certain context. You don't want to trade in the void. You don't want to be in the vacuum. You have reference points. You need to have context. And one last thing to mention, just because I'm going through this today, this isn't like the one niche thing you can use footprints for. You can use them for a lot of different things. This is just one of many. But it's a very good starting point, I think, especially if you've just started to learn about footprint and you want to sort of get up to speed on how you can use it quickly or understand it better. So we'll just dive in quickly to something that again is very noticeable on the footprint is something you can transplant again from market profile. So just as a quick reminder, double distribution days on the market profile. An example of which I have on this day, on the 12th of December in Treasuries. And then, the way we traded in and around it on the following day on the 13th. So just as a reminder, on these double distribution days, you want to have a situation where you have a small range where we rotate for quite a while, i.e. in this zone here. And then for whatever reason, on that day, we have perhaps new information in the form of economic data, new information in the form of news, or perhaps we just have some kind of positioning which for some reason decides to just leave the market, and because of all that wound up positioning is got to unwind, and then we have this very quick and aggressive break in the market, and hence and then later once that position is undone, we come back and we sort of churn in this zone here, and hence why we get these sort of two double distribution days. And because of that, you sort of know what you're looking for in the context of where you expect certain order flow to come in or not come in, or for the market to sort of keep doing what it's doing as the day progresses. And essentially what you're looking at is you're very interested, once this sort of the second distribution forms, you're very interested to see what the market does in around this area here at these sort of highs, as put on, if you can't see it properly, it's on this sort of dotted line. And the reason I say that is because you would expect while this day is forming, this will often act as strong resistance in the form of two ways. One is any attempt to trade back above quickly just peters out. You know, there's a bid that takes us higher, and then suddenly the second we get there, no bid comes through anymore. There's no follow through, and everything just dies down, and it's just all quiet, or so on. Or what happens is a lot of the time you might actually get, you know, some more volume building here, because everything that's just everything that comes through at this level, it just gets absorbed, and then eventually the market rotates back down. But eventually, in trading these kind of days, it's actually more interesting to trade it the next day, where you would expect two things to happen. A, you would expect the market to, you know, break back, go lower and sort of break yesterday's lows and keep going. But again, you're very interested to see what happens at this high of the double distribution, because you want to see if there's any, you know, a bid that actually does come through, takes us above, and then, as I've written here, there's a very strong tendency for the market to not only, at the very least, trade through this area where we left this very low volume area where we spend very little time, but actually end up testing the low of this distribution as well. So, you know, at the very least, the market can trade in here, trade higher, and, you know, you have a decent expectation of where the market might go. So that's what you'd expect in a very standard sort of double distribution day. Again, you know what you expect, you know what you want to see. So taking that forward, we're going to look about how you can transplant that sort of mechanism of how double distributions are formed into a footprint. But before I do that, let's quickly look at the context of the footprint example I'll give you on the next slide. So this is in Bund, and this was on Friday, where we've had the non-farms. So the context of this day is the fact that NFP came out, and we had weaker job numbers, but we had significantly weaker average wage growth. So in effect, in both situations, you would expect a very strong bid to come through bonds, you know, and take them higher because of those two data points. And in fact, that doesn't actually materialize until much later on, and you have a very aggressive offer that not only took Bunds lower, but it took treasuries lower, and then you know, eventually we released and came back higher. But because you have this expectation that bonds have to bid at some point, you have at least a bias knowing you should probably want to get long. But because, you know, if you traded long instantly just after data is released, you would have been offside, and you eventually would have had to puke it, the position. But, you know, you're still in the game, and you want to get along because, you know, it's good data to trade off. But now you should probably be sort of, you know, as I said here, you'll need structure and confirmation that a bid will actually come, because, you know, we've done the exact opposite of what we should have done. So this probably is not an environment where you just want to take momentum based, you know, just on the ladder, because that version of events didn't play out essentially. And what Bunds did eventually is we traded into 01s, which will be relevant in a second. Thursday's low, traded lower, found a decent bid, and then came right back higher. And, you know, other than yesterday's low in that situation, there wasn't really much structure within the day when you look at, you know, let's say a candlestick chart or profile, to really get you in with a very strong conviction, with a very sort of more binary, knowing where you're wrong, exit, more binary stop. But what happens is, in this situation, the footprint is actually very useful. And what I put here is just the footprint in itself, and see if you can, and I'll clarify this in a second, you can see here the actual double distribution that forms in that event. So essentially we're trading up here before the data comes out, and again, transplanting what we know about double distribution days, there's information that comes out that takes us lower, and we form the second distribution. Well, what I've done on this is actually, and what I would recommend sometimes, perhaps, if you're looking perhaps just at the shape of the profile, is just to take the numbers off. And a lot of the time you can spot it a lot easier, and you should be able to see this on the chart. Again, you can see the double distribution easier. And of course, going through what I've just mentioned previously, what you're looking for is this area, the high of that second distribution. Now you know once the market trades above this, 96s, 97s, there should be a decent bid that comes through. And if that occurs, and in the way it did with this decent volume on the next print, once that occurs, we should not only trade above yesterday's low, 01s, but we know just purely taking the double distribution structure, we know that not only it should fill at least to here, but at least test the low of this distribution at the very least. And in doing so, we have a decent amount of ticks which you can grab as a sort of minimal target. And if the market does actually decide to finally go on the on the bad NFP data, there's potentially more upside. And secondly, because you know what should or shouldn't happen, you can confidently say that you get long here, and then you should orientate depending how you want to trade. Stop towards these lows. We've had a good tail there, so it's not a very bad place to put a stop. Okay. And yes, as I said, you want to look at the shape of the distribution. We have an acceptable tail, and if volume comes in and we have decent participation, it should take us higher. The participation doesn't die out. It actually comes back in, and there's interest to go back up higher. Obvious shift in delta in the next column, and so on. Okay, so that was a very, very fast way in which you could easily apply a footprint, have conviction in, have a systematic entry, a more perhaps a binary entry and binary exit, and you know very specifically what you're looking for. And that's much easier in my opinion, or at least in how I like to lean on things, is that you have the context of the day, you know which way you want to go, but perhaps it isn't so prudent to go, okay, I'm just gonna buy this price and then just have an arbitrary stop. You have structure, you know what you want to see, your stop's in a much better place, and then in of itself, this structure should have enough edge where the market should trade through it. Okay, now the next thing I've often seen a lot is using these day types, long liquidation or short covering, but in this example, look at long liquidation, or AKA B-shaped days. B-shape being, just as a reminder in case you may need it, but essentially the reason we have a B-shape is that we have a very, very fast, aggressive offer right from the open, from a range, and then the rest of the day is spent just churning in and around that, towards the lows, and then of course we have sort of a B formation. And as I've said, usually this is a break from the previous range, and it's a very aggressive sell, and you can tell that there is not only size coming into the market, but you also have positioning that has to be sort of undone. And if you watch this on the ladder enough times, you'd often feel like there's perhaps a desperation to just get out, and it's sort of like, as the name would imply, long liquidation. The longs are just giving up. And that's it, the day's done. Fairly slow, range bound, there's no real participation after we've made that initial very aggressive, very exciting break lower, and then the market just trades throughout the day. No one who can move markets really is interested in trading it, and that's what we've done. And now what happens a lot in these kind of days, and perhaps the next day, is that again, much like the double distribution, this will often provide enough resistance where perhaps you might have a slight edge in understanding what may or may not happen in and around that area. So if you expect it to be resistance, from there you could work out a suitable entry, perhaps where you like to exit, or how do you like to manage that trade. So again, taking that market profile understanding, we can again apply it to footprint. And what I will do, just in the previous example, I'll leave the sort of the more nuanced information in terms of numbers on, and then I'll take it off so you can see it. But essentially, again, this was in Bund. And what happened is this was on Monday, the Monday following the NFP. The context of the day, the NFP basically ended up taking the market eventually flat for the day, unchanged nearly, formed a range. And you could tell for the previous few days, Bunds were just using any sort of excuse just to sell off. The UK GDP data came out lower, Bunds should have gone higher, but instead it just sort of petered out. So any excuse to take the market higher doesn't materialize, and all it does is just sell. And you could tell from that morning, from the overnight range, and if I just take off these the numbers, this is the same chart. We had an overnight range in early trading session, but what happened yesterday on Monday was that we had very sort of slow but persistent risk on flow. We had equities, constantly hitting the high. Bonds were sort of, feel like they're, starting to offer. And suddenly what happened is we broke that range very aggressively, much like you would expect a sort of, a B-shaped day to play out. And exactly like you see in that shape, that positioning, we have the B shape. And again, as I mentioned in the previous slide, what you would expect is this sort of the high of that sort of ledge-like area to provide enough resistance. And eventually it did. And not only that, importantly, but you can see at the other footprints, eventually when we started getting close to this high, there was very little there was no volume building up. We didn't start stacking the volume. We didn't have, big participation trying to trade through it. And when we traded through it, we brought in big volume in comparison to what we've seen here. Essentially, we just have a finished auction. No one's interested in trading, comes back down. And then on the flip side, whenever we do come to the lows, we start building more volume. There's more interest being done lower than higher. And yeah, as I said, if you're watching this on the ladder as well, you could tell that there was noticeable aggressiveness to just sell, and there was there was a change from a meandering, range-bound action to just very quick, aggressive selling, and so on. So, now that you have your shape, you know how that formed, importantly, in the context of what happened on Friday, you understand how that B-shaped structure forms, and you've seen how the market trades back up to it. So at the very least, using that information, you should know, again, adequate resistance. You can manage your stop somewhat adequately well, and then the tendency that the market will at least take that out, not that much in Bunds, but it should at least put you well on side for perhaps another run lower. Okay, so a few things to conclude. Importantly to take away from this is, one question I get sometimes when I talk to this, to people, is why not just look at the ladder, on the volume profile you have on the ladder for the exact same trade? Sometimes that's true. It's very true. If this is a fresh print here, and we haven't traded anything for that day, yes, you can very well see the same formation on the ladder, and yeah, you could watch it and comes back up, it doesn't get through, same kind of thing. But as I mentioned on the slide, what if the market's already traded there a few times? Not that much, to have an effect on that positioning, but just to sort of skew the view of your of the shape itself. But because you have a split view based on time frame or rotational chart, it's much easier to see it rather than cumulative the whole shape of the day. And yes, as I mentioned before, because the market's fractal, you'll often see this kind of activity, 1 minute, 15 minute, 30 minute, hourly, or range-based chart. You will see it, but of course the profiles themselves or the shape will occur in sort of different periods, and so on. Now, the only things I have to mention about the way these shapes form is that you should at least give some consideration to the kind of markets you're trading, thick versus thin. You're not going to get the same profile shapes when you're trading crude oil versus trading US Treasuries, obviously, but perhaps that will be more of a benefit to you or worse. It's something you have to consider and something you have to watch. Much like essentially, looking at different time frames, some people perhaps won't believe it when I say it. You can see this on the 1 minute in crude or something. Perhaps in crude oil you can get a not sure if you can see this line. So, in crude, you might have it on 1 minute B shape. Again, that may or may not work, but that at least there's a slight statistical tendency for that shape to play out as it should. And, have a look at these kind of things, see what you see and see what you like trading. And yeah, the one thing I mentioned is you should be careful with this sort of market profile logic. We're talking about transplanting what should be on how a day plays out. We're talking about double distribution day, a B-shaped day. So therefore, because you use that logic, you know that the next day there should be something that should occur or shouldn't occur. But if you're using the same kind of pattern on, let's say, a 15-minute footprint, how long is that going to be relevant if you're applying the sort of the day type pattern? But unfortunately, that's much up to you to decide. Perhaps the 15-minute is only relevant, and then by the time the session, as I would recommend, by the time the afternoon comes around, it's most likely whatever caused that shape is not relevant. The positioning's changed, new participation, new traders coming in. Again, so not because you see something on 5 minute means that's exactly how the day is going to play out. You should be wary of the sensitivity of time affecting these profiles. Because I said you could transplant the logic of market footprint of market auction activity, market profile into footprint, but that doesn't mean the exact same rules apply. There are nuances. There's something you're gonna have to change, but it's sort of a quick and crude way to sort of get a feel for footprint and understand how it works. Okay, so my last recommendation is if you're new to footprint or perhaps you want a more sort of detailed understanding of how to use it, I would say perhaps, and but you already have an understanding of market profile, I would say try looking at profiles in the sense that you would want your software to show you a volume-based profile, and you may or may not want to take off what's traded in the bid or the offer, the numbers. That's up to you, and see how the market trades in and around very specifically shaped profiles like this one. It's not going to be perhaps very frequent, but once it does, it may give you enough edge to lean on. Look at this on different time frames that you feel is perhaps relevant to your market, or perhaps look at it on a range-based chart as well. And perhaps take other formations for market profile and apply to footprint, and then see how the market trades in and around that area.